Welcome to Cross-Border Tax Talks, where we discuss the latest trends in international taxation, from U.S. tax reform to the UK's latest developments. I'm Doug McHoney, PwC's U.S. International Tax Services leader. You can follow me on Twitter at xbordertax. This week, we're back in PwC's Washington, D.C. podcast studio, where I'm excited to be joined by PwC International Tax Services partner Neil Edwards. Neil is an international tax partner loosely based in our Chicago office, where he's part of our national integrated global structuring team. Neil is on secondment from our London office and has now lived through two major international tax reforms, one in the UK and now one in the US. Neil, welcome to the podcast.
Thanks, Doug.
So, Neil, I am very fascinated with the process that took place in the UK, moving from a worldwide-ish system, similar to what the US had with the foreign tax credit system, to a what I would refer to as a more proper territorial system. Certainly more proper than I think what we ended up with from a US perspective. But I think it was back in 2009, which, if you can believe, that was 10 years ago, where the UK adopted the territorial system. But there was really a process that took place in the UK over a series of years before, as the UK really evolved to this territorial system. So maybe before we even start comparing the two regimes from a UK and a US perspective, talk a little bit about maybe the history of the UK system and what are some of the key components.
Yeah, sure, Doug. And I think one of the things that shocked the UK-based people amongst us when we saw US tax reform happen is UK reform took many, many years. There was lots of consultation. There was draft that came out. They were debated, and there were various different groups. And it kind of felt like US tax reform happened in about 3 weeks. And so the amount of phenomenal change in such a short period of time was just was similar in the UK, but it just took such a longer period.
And I think as we look back at our history within the US and the 86 Act, and Richard McGinnis was on last week's podcast, and we reflected on that as well, that there were really significant changes that took place in the early 80s up to the 86 Act. And obviously the TCJA from about a year and a half ago fundamentally was just different than that in that process. But I think that's just kind of where we are from a political perspective here in the US.
Right. So I think if you go back to, like you say, 10 years, a little bit 10 years more than that ago, and look at what was going on in the UK at that period of time, I think it was the UK had this tax system that was felt to be internationally uncompetitive. And that was causing a lot of pressure. We saw a number of multinational companies based in the UK invert to other countries like Ireland, Switzerland, and so on, and that caused shockwaves throughout the kind of UK government and revenue people.
And was there, because there was ability for companies to be able to change their parent to a non-UK parent and do that in a manner which didn't trigger a boatload, I'm guessing, of UK tax.
That was yeah. They could generally do those as tax-free transactions, and it had a significant effect on how mostly their foreign profits were then taxed. And I guess you then got to also put the EU dimension on this, which had at least a couple of effects. One was it made it very difficult for the UK to do what the US did with some of the inversion transactions with the 78-74 rules, and essentially stop people and put negative consequences on it, because the freedom of movement and other principles in the EU makes it pretty hard for someone like the UK to shut the door on companies or kind of penalize them for moving to another EU territory.
Yeah, and you make reference to our Section 78-74, which is an anti-inversion provision, which generally taxes the migration of a U.S. parented group to a foreign parented group.
Yeah. So there was some inversions going on, and there were also other UK-based multinationals. And again, one of the things you see with UK versus maybe the US is the multinational companies tend to have a relatively small percentage of their profits in the UK, right? Just because of the size of the UK economy versus the US economy. So these were, those types of companies really had massive foreign profits relative to their UK profits. And they felt they were being taxed uncompetitively compared with, people incorporated elsewhere. And at the same time, the UK's control foreign company rules that in some situations seek to tax profits that were not, earned in UK companies and attribute them to the UK parent, those were coming under challenge in the EU courts as well. So companies like Cadbury, Schweppes and Vodafone were taking cases against the UK government, which basically were saying that the CFC rules were probably not fit for purpose and potentially unlawful. So we had complaints from multinationals about competitiveness, realization that the UK system had not kept up with the global economy. We had pressure with people leaving, and then pressure with the existing rules being essentially driven unlawful, and that just really made the system untenable and caused successive governments to actually look at how to reform the system, make it more business friendly, make the UK more attractive, but just have a more fit for purpose system.
And what was that old system? So there were obviously certain types of income under your CFC rules that created immediate taxation in the UK. And then was income generally deferred if it wasn't CFC income until that income was brought back to the UK, and then there was an foreign tax credit regime?
Yeah, that's right. So the basic system. So one, the UK had a much higher rate than it has today. It was up at like 28%,
right? And
a few years before that had been 33. So it's kind of gradually come down, but it's stuck at 28%. That was felt to be reasonably high. Generally, dividends that were received from foreign profits were taxable in the UK, but subject to a foreign tax credit regime. The detailed mechanics quite different from the US rules, but similar in concept.
Okay.
And then we had this kind of, like you say, anti-deferral rule called controlled foreign company rules that would seek to tax certain profits of kind of foreign subsidiaries of the UK entity and in the UK now, mostly focused on passive income like interest and other income, but also the rules at the time were pretty broad, and all sorts of business models were also impacted by these arrangements, where they were doing foreign sales and foreign principal arrangements and many different types of transaction just made it very difficult for UK multinationals to effectively structure their overseas businesses.
Okay, so then what was the process, and then how did those rules change from that kind of what I would refer to as kind of a worldwide or a deferral type system? Yeah,
so there was a great deal of consultation. There were documents put out essentially by UK Treasury, which is part of the UK government, saying, we realize there's these pressures in these certain areas. We want to make the UK open for business. That was one of their kind of strap lines, and essentially encourage business to tax the profits that were what they would kind of consider like properly attributable to the UK, but not to kind of penalize modern multinational businesses who would happen to put functions and assets and other things in outside the UK for good business reasons. So they came up with a number of different like prongs to the system around the overall policy as to how they were going to make it work. One was significant rate reduction. Mm-hmm. So the rate was going to come down from 28, I think, originally to something like 24. I mean, we've ended up continually drifting south of that, and the UK rate is ultimately going to hit like 17% next year.
Right.
But the original,
we're almost here. We're almost to that. So I remember when that number was thrown out, there was like, there's no way that we're going to get there. And who would have thought the U.S. would get to 21 and the UK is going to end up at 17?
So it was a massive change. But the original proposal was much less favorable than that. It was some other number. Mm-hmm. So there was the rate reduction. The second piece was a dividend exemption. And that was actually the piece that came first. So they started kind of gradually shifting the rate downwards. But then they said, well, actually, we should no longer really be subjecting these foreign profits to tax when they come back to the UK. We still have our like anti-deferral CFC regime for certain types of profits that we feel have kind of almost been artificially, for want of a better word, kind of shifted offshore. But as a general matter, real foreign profits from real business profits that kind of sit offshore were going to be exempt under this dividend exemption. So that was the first thing. That was, I think it's like 2009 or a little bit later that they started allowing foreign profits to come back tax-free. And then they had the CFC changes were probably the biggest and one of the most complicated aspects of the rules. There was a lot of debate, and in fact, I think they ultimately missed their original deadline because they had to push it back because there were all these questions around how do you design the system, what should be in, what should be out, how do we treat passive financing income was a massive bone of contention, and also again, as is pretty topical given the kind of current Brexit aspects that are going on in the UK, you can never forget the EU when talking about UK policy in this area. Right. that they had to make their regimes consistent with EU law. And so everything they had to do, they needed to make sure it would be kind of compliant with the treaty obligations and so on. And then alongside that, they had a series of other aspects that were designed just to make the UK a bit more attractive. So things like R&D credits, patent box regimes that give reduced rates on certain income. Those were looked at and either improved or changed or introduced around the same time to encourage business to move more income into the UK. And then the one big thing that was like the negative or a piece of the kind of pay for this reform was what they did about interest deductibility. So prior to this tax reform coming in, the UK basically didn't have any like hard and fast limit on interest deductibility. There was like an arm's length rule for related party debt that meant that you had to kind of justify that you could have borrowed that amount of money, but there was no overarching interest limit. And so there was a lot of debate about introducing one, and the concern was, well, if we've got UK parented groups that are borrowing and that money is effectively funding acquisitions offshore or investment offshore, and the UK is no longer going to tax the profits from those investments, is it appropriate for the UK to still allow a deduction for that interest expense? And as it turned out, they introduced something called the debt cap, which attempted to restrict, to some degree, UK's borrowing. That's evolved over the last few years as we've had BEPS into essentially a 30% cap on EBITDA.
So there's no direct tracing or like right as far as if you borrow to then fund a foreign deal. They just went with a more, generic or more just to avoid having to deal with the tracing issue that since money is fungible, just 30%.
That's right. That's where and that was in more recent times than that as well. The original cap was basically saying you can put your third party debt in the UK, and actually they ended up being pretty generous. They said you can put all your third party debt in the UK, and we'll allow you to deduct that. But you can't go further. You can't base erode the UK with interest deductions from, upstream loans from foreign CFCs, or if you were, foreign parented group, from additional intercompany debt. But as long as you didn't go more than the third party, that was okay. So that rule was pretty generous at the time, and it's been moved to this kind of BEPS compliant 30% rule in recent years.
Is there still an interest cover rule? As far as just, I've always viewed that as more like a cash flow type of test.
Right. Yeah. So the UK basically has like a transfer pricing rule that would include debt arrangements in that. Okay. So the debt has to, if it's related party debt, it's got to be arm's length. So that would include things like, is this an appropriate amount of debt? Could it be supported by the cash flows? But it's not a mechanical test, right? It's a facts and circumstance type test. So those were the components of UK tax reform. And if you compare them with what happened over here in the US, actually there's quite a lot of similarities, right? So rate reduction, number one thing, right? That was there. Reform of the taxation of dividend income from foreign subsidiaries to essentially make it exempt. That was another thing. Some changes around the kind of foreign profits to territorial bit of the regime, and no doubt we'll come on to that because the systems ended up looking pretty different, but at least the business ask in the first place was similar, right? That these foreign profits shouldn't be taxed again in the UK or the US. And then
I'm not sure we really ended up with that in the US.
Yeah. The result might not have been, it might have made it the same.
But the businesses were certainly arguing for similar type of results.
Right. Yeah. And then some other incentives around the outside, right? The patent boxes and the R&D regimes as compared with the FDII regime over here that kind of gives a more attractive rate on certain profits brought back. So I think you can see quite a lot of similarities as to how the rules have worked out, and the pressures in the first place were to some degree similar, right? In terms of international competitiveness being the one thing that US businesses were complaining about, and 10 years ago, UK businesses were in exactly that same position.
So there are some other provisions too in the UK that, because I want to get to some more of the comparison, but that I know that are particularly challenging for US advisors, and that we've also I've heard some people, and there's been some press out there with respect to, let's start with maybe the diverted profits tax. And, is that in substance similar to our GILTI regime? But or does it end up with kind of a similar result? Can you provide to our audience, at least at a high level, what is this diverted profits tax? And that is, I think, is that a few years old at this point? It was a really reaction to the BEPS, and how does that compare, and how do we try to make that apples to apples as far as what's taking place in the U.S.?
Yeah, that's right. And I think that, again, there's some similarities, but also quite a lot of differences. And the timing-wise, diverted profits tax was not part of the UK reform, right? The UK reform was driven by being open for business. It was a very, very pro-business reform, and other than the limited interest rules, was all pro-business, really. What then happened is we run into BEPS, right? And this kind of general concern around the world around how much tax multinational companies were paying, particular pressure on the tech sector and what their effective rates of tax were, and how much of those profits sat in the UK versus overseas. And then we saw the BEPS process as a result of that. And then the UK, in many respects, has been an early mover in a way which has frustrated a lot of multinational companies, for sure, in that they've been heavily participating in the BEPS process, but they've also not been afraid to introduce unilateral measures when they see fit in advance of that. And I think if you compare DPT with GILTI, really GILTI is like an outbound provision. In a sense, it's the US MNC saying, I'm going to tax low tax profits offshore if they're effectively under the 13.125% rate, and that's low tax profits of my CFCs. And the GILTI regime doesn't care whether those profits ought to belong in the US, right? It doesn't say are the people that are generating those profits or the original intangibles or any other aspect of that, does it really relate to the US? It's just a kind of rule that says, well, no, if you're below this rate, we're going to tax them back here, and maybe that will encourage you to bring more activity back to the US. But it's kind of a very kind of rules-based provision. Well,
arguably, it's intended to say, well, that the U.S., because it's the parented company, is entitled to tax, anything beyond the 10% return on the depreciable tangible assets. So that residual profit should come back to the U.S., and then they only tax half of it.
Right.
But it doesn't look to see whether those profits should have or actually originated in the U.S., but arguably it makes the assumption that those should have originated in the U.S.
Right. But if you said, if a U.S. company goes out and buys a foreign multinational that's, never set foot in the U.S. whatsoever, but just happens to have a low effective rate of tax or some subsidiaries with a low effective rate of tax, those profits get picked up under the GILTI regime away, right? So the diverted profits tax in the UK was really aimed at some of the areas that BEPS was aimed at, which was, and it's nothing to do with CFCs or subsidiaries of the UK, right? So diverted profits tax just applies to any company where they fall within certain of these provisions, and basically there are either UK deductions created or UK profits avoided where there's some kind of lack of economic substance or a low effective rate and some connection with the UK. So it might be, if you look at some of the things that BEPS was targeting, like structuring your business model to attempt to avoid a permanent establishment in the UK via kind of threading through these technical rules as what constituted a UK taxable presence. So those rules targeted that type of arrangement and said, well, if you've done that and avoided a permanent establishment, then maybe we'll just pretend you had one anyway, because we think some of this profit really belongs in the UK. And similarly, if you're claiming deductions in the UK for certain payments abroad, where maybe there were questions around the transfer pricing, or has the value been properly attributed to the UK, or do you have substance in the jurisdiction where you're paying to? Again, those profits are going to get brought back and potentially taxed in the UK. So I think the UK rule is much more focused on some attempt or perceived attempt at a profit that really ought to have belonged in the UK and has been shifted. So it's partly related to the rate, but it's really related to moving profits that the UK government thinks ought to have been taxed here.
And again, it can apply to any related party, right? It doesn't have to be kind of CFCs or within that chain of ownership like we would see with the U.S.
Absolutely. And I think you'd actually say, if you were to look at who the target of the tax was, whilst to some degree it was UK multinationals, and UK multinationals have been targeted under these rules and have had to pay tax under these rules, the predominant target was like the US multinationals who had shifted profits out of the US and were kind of sat in some low tax jurisdiction as a result. At least that's certainly what the press and a lot of the kind of revenue activity has been around.
Right. So one of the other things that I think is interesting, you mentioned that the UK was relatively, well, not even relatively, early adopters of a number of the BEPS provisions and BEPS concepts, right? And I think one of those particularly is the hybrid mismatch, kind of the hybrid rules, as we've referred to them here on Cross-Border Tax Talks. Obviously, the U.S. has now gotten into the game after 267 Cap A. We had a whole podcast with Nils Cousins on here going through those rules and some of the policy. Well, the UK adopted those. How long have those been? Those been out several years. I mean, they really predated even ATAD, Europe, the EU agreeing to having all member states adopt these anti-hybrid rules. The UK had already adopted those, but talk a little bit about those rules and maybe how they compare to the US.
Yeah, so we've had 3 or 4 years of those rules now, and you're absolutely right. I mean, they were clearly part of the OECD BEPS approach, right? And the UK was at the forefront of that and just made this decision that rather than wait for Europe to say it's got to be done by this date or whatever, they went right in and did it almost straight away as even as the kind of final BEPS papers were being debated and agreed. And the rules are pretty similar, I think. Generally they're looking at the same types of arrangements, so deductions in one territory without an inclusion in the other that's been driven by some kind of difference in tax law or characterization, or the ability to get deductions in 2 different territories through the use of entities that are treated differently. So the principles, again, very, very similar. I guess key differences for me would be the US rules are focused on interest and royalties, right? At least in an inbound context. In other words, foreign parent, US making payments to its foreign parent.
Right.
It's only interest or royalties that are caught. Under the UK rules, anything can be caught. And that can include cost of goods sold payments. So the UK just buying goods that it then sells in the UK, but buying them from a related party, if there's a hybrid arrangement there, and not even just directly but indirectly in the chain, that's potentially within scope of the rules. And that's the US rules have been thankfully somewhat more targeted in kind of focusing on the kind of passive flows. That's one difference. There are other areas in where the UK rules have evolved over time, and probably are a little bit outside the OECD rules in certain cases. So they extended them to cover some arrangements where it wasn't necessarily hybridity that was causing the mismatch. It was maybe zero taxation in certain countries. Even though that was nothing to do with hybridity, but there was some kind of hybrid aspect to it. So they did kind of catch that within the rules. Conversely, the US has picked up on certain things that maybe the OECD didn't and the UK didn't. So like notional interest deductions is one of the areas which are not within scope of the UK rules, but are within scope of the US rules. So there's I think fundamentally these are very, very similar rules. And if you look at the type of cross-border arrangements that are caught, you're going to probably see like 90% overlap, I would guess. But there's just a difference around the edges. The other piece I think that will be interesting as we see the US regs develop in this area and the US kind of practice develop is the difficulties in actually interpreting them in complex business situations that we see. And one of the really nasty consequences of the UK rules has been that they're actually very, very mechanical. And the UK actually had a predecessor to these hybrid rules called the anti-arbitrage rules that was attached certain similar structures, but it had a purpose-based test. So it said, well, if you've got a hybrid structure and you're using it to get a UK advantage, then we'll apply the rules. The revised rules, both in the US and the UK and the OECD rules, they don't have that purpose-based test. And so the difficulty is when you come up with a set of mechanical rules, dealing with cross-border taxation, where you've kind of got to understand the different treatment in the UK and the US and multiple other territories, is it's near impossible to actually draft those rules without unintended consequences. So I think that's one of the things that companies that do business in the UK and the UK revenue have been kind of battling with is a set of rules that appropriately deal with the kind of key structures they were targeting. But then how do they apply in all these other situations? And there are just differences in tax systems, right? And they kind of, then when you're trying to apply these hybrid rules, sometimes they're catching arrangements that really probably weren't intended in the first place, but it's then very difficult to change those rules.
Absolutely.
And one of the things we were talking about the other day around the way the kind of regulatory authority in the US versus the UK, right? And the UK revenue authorities and UK Treasury don't generally have the sort of regulatory authority that exists in the US.
Well, there's much more detail in your statutes, right?
Exactly. So they draft the statute. It's a set of prescribed rules. They can give guidance on those rules, but they can't actually, alter the effect of those rules through the guidance.
So Parliament will grant authority to Treasury or HMRC to then draft rules. The rules are developed by Parliament, and then they can give out some interpretations.
Yeah. So there are certain situations, regulations can get issued, but those regulations are different to the types of regulations you see out here. They're generally dealing with very kind of detailed administrative aspects of the law, and those regulations themselves generally are subject to parliamentary approval. But they're just not. There's not broad authority given to, the equivalent of Treasury to go write some rules that actually more appropriately define what Congress or UK government meant by the rules. But what it means is it's a bit like passing a law over here, right? If you draft a law, you pass the law, and you find out it's not working exactly how you mean it to work, the process to getting it changed is not straightforward. It's back to, the revenue agreeing with the Treasury people that they want to make a change, the Treasury people agreeing with ministers that they want to make a change, and then ministers finding space in another kind of finance bill to make that change and getting it through Parliament and so on. And there's limited space for these things. That combined with there's plenty of other things going on politically in the UK right now, right? Means that making changes are difficult, and so if they kind of miss something when they draft the law, it's very difficult to then get it fixed afterwards.
Right. So we've talked a little bit about GILTI as far as comparing the different systems and the way the U.S. system works now with this, arguably worldwide system where we get an exemption for, the GILTI income, which is anything beyond a 10% return on depreciable tangible assets. We talked about the 267 Cap A, these anti-hybrid rules, which the UK has been leading the charge with. One note I will make on that is that it's interesting that, the two jurisdictions or two of the bigger powers that have developed the anti-hybrid rules, each one of them has added on additional types of transactions beyond what was originally suggested by the OECD. It's going to be very interesting to see what the rest of the EU does between now and January 1st of 2020. So over the course of the next 5 to 6 months to see if each jurisdiction comes up with their own rules and keeps adding on to the list, which, as you had mentioned, makes things very complicated. But what I wanted to get some of your insight on is the base erosion and anti-abuse tax, this BEAT concept now that we have in the U.S., which we've talked a little bit about on the cross-border tax talks. It generally says to the extent that you have related party payments, deductible payments beyond a certain threshold. So first of all, you need to have greater than 500 million of sales or revenue or greater than 3% of your deductible expenses, and it creates this alternative minimum tax type regime where you have to add back those deductible expenses to related parties. And then if you multiply that amount and by 10%, at least this year, last year was 5%, this year it's 10%, and that amount exceeds your normal corporate taxation, you are now subject to the BEAT. Is that more similar to the diverted profits tax? I mean, how in your estimation does that kind of fit in with either what you've seen in the UK, or how are you trying to get your arms around this now as you're practicing in the US?
Yeah, I mean, I'm not sure the BEAT's like anything else that exists elsewhere, and it's if you compare it with the UK, I think the general thrust, if you spoke to policymakers in the UK that were developing tax reform, and to some degree the kind of BEPS process, is they're trying to say the UK's got a territorial regime that seeks to tax in the UK the profits that are properly attributable to the UK activities, nothing more and certainly nothing less. And so as a result of that, they then brought in these rules that, the diverted profits tax rule is a rule that really tries to say, we don't think you've got the right amount of profit here, so we're going to bring some more back based on the activities you're doing in the UK. BEAT's just a very blunt instrument that maybe is going after the same thing, but does so in a very draconian way of just saying, well, if you've got too much related party payments, then we're just going to essentially disallow them. And it doesn't matter that relates to payments you're making for real value you're getting provided by the multinational company in some other territory, that the US may really need in order to generate its profits in the US and couldn't easily be done in the US, or that's just good business sense that it's been set that way and it's an arm's length payment. All those types of things, that's irrelevant to BEAT. And I think that's the big contrast with the UK and mostly other similar regimes around the world that have come out of BEPS, is that they're generally trying to get the right amount of profit, whereas this BEAT provision is really just saying we're going to bluntly target related party payments. And I think it's one of the things, again, that's been challenging foreign multinationals with US businesses most is this idea that this completely legitimate business expense is being not deductible for no obvious real reason. And again, some of the anomalies you get when you come up with that sort of arrangement, that things that are paid for by the foreign multinational because it makes business sense to collect them in one place and then recharge to the US. Right. That type of, and if the US paid for it directly, it's kind of fine. That type of anomaly just is creating some really odd results.
Yeah, and I think one of the things we've talked about on the podcast is just how surprising a number of us have been, the number of U.S. multinationals that have been impacted by this, when this was thought to be an inbound provision, in other words, for foreign multinationals investing to the U.S., but the number of U.S. multinationals that are caught up in this. So maybe, Neil, kind of in closing, would love to hear kind of lessons learned, or any insights that you have from the UK reform. We're still obviously very early. We don't even have we're hoping to get finalized regs on a number of the provisions here within the next days or weeks. But, we started the discussion talking about that the UK made their changes because there were a number of UK MNCs that had moved parented, whether Ireland or other structures, effectively inverted out of the UK. After that change, did we see a number come back, and what, if that is one or any other lessons that you think learned from the UK moving to a sort of true territorial system?
Yeah, okay. I mean, I think a few things. One, going back to probably the first comment I made, which was the UK taking a number of years to get it right, or at least getting it close to right, I suspect helped given the complexity, and as well, the UK didn't introduce the rules and then decide to, or bring in the regulations that really explain what the rules meant.
Sure. Over
essentially a 2-year period. After bringing them in, they were brought in and then transitioned over a period of time. And I think that worked reasonably well for companies, and is one of the things we're seeing here right now is proving really difficult, right? Is you don't even know what the law is. It can be a bit of a challenge to understand what impact it has on your affairs. I think the effects on businesses, I think, was actually incredibly positive, at least for those early years and almost pre-BEPS, if you will. So we saw a number of companies who had moved offshore return back, a reasonably significant number of them, and it wasn't just that. We saw other companies that had decisions around where to locate mobile aspects of their business doing so in the UK in a way they probably wouldn't have done pre-tax reform. And it was really a combination of, one, the rules were more favorable, and so the UK became more attractive. That combined with the other advantages the UK had in terms of the size of the economy and kind of place generally people were happy to locate to and live and work and so on, but also the general language coming out from government around being open for business, and that was right. And trying to give people certainty and so on. So there was some pretty positives there. I think you probably then maybe start marking the cards down in more recent times. So the question: did they go too far? Were they too generous in the first place, or with the BEPS provisions that have come in, diverted profits tax, some more recent changes around offshore receipts taxation that the UK has gone in for, being kind of first in line for all of the BEPS changes, and maybe the general approach to auditing businesses and how challenging the UK has been, has maybe put a bit of a blemish on some of those kind of positive changes. So this kind of question around is there certainty and open for business and so on, I'm sure government would still say that is the case, but it's probably not quite as favorable as it was.
Well, the political environment has certainly changed significantly over the last 10 years. And I think that's safe to say both on this side of the pond as well as the other side of the pond. So I think we're going to have to leave it at that. Neil, thanks for tuning in to this week's episode of Cross-Border Tax Talks. Thank you, Neil Edwards, for joining me on this episode of the podcast. I'm Doug McHoney, PwC's International Tax Services Leader. Stay tuned in 2 weeks for another exciting edition of Cross-Border Tax Talks.